The Federal Reserve, often referred to as the Fed, plays a pivotal role in the U.S. economy, but its actions ripple across global financial markets as well. As the central bank of the United States, the Fed is tasked with maintaining economic stability through its monetary policies. At its core, this means managing two primary goals: controlling inflation and ensuring maximum employment. It achieves these goals by adjusting the supply of money and influencing interest rates. Interest rates are one of the most powerful tools in the Fed's arsenal. These rates dictate the cost of borrowing money, which in turn influences consumer spending, corporate investments, and financial market activity. When the Fed raises interest rates, borrowing becomes more expensive. This discourages spending and investment, which slows down the economy and helps curb inflation. Conversely, when the Fed lowers rates, borrowing becomes cheaper. This stimulates spending and investment, boosting economic growth. Recently, the Fed has aggressively raised interest rates to combat the highest inflation seen in decades. These rate hikes have cooled the economy, bringing inflation closer to the Fed's target of 2%. However, many experts believe that by 2025, the Fed may pivot and start cutting rates. This potential shift could have significant implications for the stock market, with the possibility of driving a major rally. The Fed's role in the economy. Why interest rates matter. The Fed's decisions about interest rates are like setting the thermostat for the economy. When inflation heats up, meaning prices rise too quickly, the Fed raises rates to cool things down. On the other hand, if economic growth slows too much or risks entering a recession, the Fed lowers rates to stimulate activity. The reason interest rates are so impactful is that they touch nearly every aspect of the economy. For consumers, higher interest rates make mortgages, car loans, and credit card debt more expensive, discouraging spending. For businesses, when rates rise, borrowing costs increase, making it more expensive for companies to finance growth through loans. This can lead to cutbacks in hiring, expansion, and innovation. For investors, interest rates affect the returns on bonds, savings accounts, and other fixed-income investments. When rates are high, these assets become more attractive, drawing money away from the stock market. When rates fall, investors tend to shift toward equities, boosting demand for stocks. How interest rates impact the stock market. Interest rates and the stock market share a complicated but significant relationship. Here's how changes in rates influence stocks. Rising interest rates, borrowing becomes more expensive, which can squeeze corporate profits and discourage growth. Higher rates make bonds and other fixed-income investments more attractive, pulling money away from stocks. Consumers spend less, which can hurt companies that rely on consumer demand, leading to lower stock valuations. Falling interest rates, borrowing becomes cheaper, making it easier for companies to finance growth and expansion. Lower returns on bonds and savings accounts push investors toward equities, increasing demand for stocks. Consumer spending typically increases, boosting corporate revenues and profitability. Historically, the stock market has often rallied when the Fed moves from a period of tightening, raising rates, to easing, lowering rates. This is because the environment of lower borrowing costs and increased liquidity benefits both companies and investors. Why the Fed might cut rates in 2025. The Fed doesn't make decisions lightly. A potential rate cut in 2025 would likely be driven by a combination of factors. Cooling inflation. The Fed's primary goal in recent years has been to bring inflation under control. After a series of aggressive rate hikes, inflation is gradually moving closer to the Fed's target of 2%. If this trend continues, the Fed may see room to cut rates without risking a resurgence of inflation. Financial stability. The Fed also monitors the health of financial markets. Prolonged periods of high rates can strain credit markets, businesses, and consumers. Rate cuts could ease these pressures, stabilizing the broader financial system. How lower rates could boost stocks in 2025. If the Fed begins cutting rates, it could set the stage for significant gains in the stock market. Here's why. Cheaper borrowing costs. Companies would have access to lower-cost loans, enabling them to expand, innovate, and improve profitability. This increased earnings potential tends to drive stock prices higher. Increased consumer spending. Lower interest rates make mortgages, car loans, and credit cards more affordable, leaving consumers with more disposable income. Higher spending boosts corporate revenues, benefiting stocks. Shift in investment behavior. As bond yields decline in a low-rate environment, stocks become more attractive. Investors looking for higher returns typically move their money into equities, driving demand and prices upward. Which sectors could benefit the most? If rates are cut, some sectors stand to gain more than others. Technology. Tech companies often rely heavily on borrowing to fund innovation and expansion. Lower rates could reduce their financing costs, boosting growth and stock performance. Real estate. Lower mortgage rates could spur demand for homes, benefiting real estate developers and REITs, real estate investment trusts. Consumer discretionary. Retailers, entertainment companies, and luxury goods providers could see increased demand as consumers spend more freely. Financials. Banks and lenders could benefit from increased borrowing activity, though lower rates may compress profit margins on loans. The risks. What could go wrong? While a rate cut might sound like a guaranteed boost for stocks, there are risks to consider. Persistent inflation. If inflation doesn't cool as expected, the Fed might need to maintain higher rates for longer, which could weigh on stock performance. Economic recession. A significant economic slowdown or recession could hurt corporate earnings, even if borrowing costs are reduced. External shocks. Geopolitical tensions, trade disruptions, or financial instability in other parts of the world could introduce volatility and uncertainty. Investor overreaction. Markets often price in expectations before they materialize. If rate cuts fail to meet investor expectations, it could lead to sudden corrections. How investors can prepare. Given the potential for rate cuts in 2025, investors should start thinking strategically about their portfolios. Stay informed, monitor the Fed's announcements and economic indicators, particularly inflation and GDP growth. Diversify. Focus on sectors likely to benefit from lower rates, such as technology and consumer discretionary, while maintaining a balanced portfolio. Be patient. Markets can be unpredictable, so long-term thinking is key. The Federal Reserve's policies will play a crucial role in shaping the economic and financial landscape in 2025. If the Fed begins cutting rates, it could spark a rally in the stock market, driven by cheaper borrowing costs, increased consumer spending, and shifting investor behavior. While risks remain, the potential for growth makes this an exciting time for investors to stay informed and prepared.